Welcome to the Deep Dive. Powered by TalkTickers, your essential intelligence brief, right from the heart of earnings calls.
Good to be here.
Today, we're zeroing in on OSCR Health. They're that, tech-focused health insurer for individuals and small groups.
Right, and they just dropped their Q1 fiscal 25 results back on May 7th.
Exactly. And the numbers were, pretty eye-catching. So our mission today is to unpack all that.
Figure out what's driving it.
Yeah, and what it really means for OSCR going forward, and maybe the broader healthcare picture too.
So the big question, is this the quarter they finally kind of turn the corner towards real sustainable profit?
That's what we're digging into. Let's see what this quarter tells us about their long game.
Okay, well, starting off, it was definitely a strong Q1 for them. Beat expectations pretty comfortably on the key stuff.
It wasn't just hitting targets, though, was it? It felt like a quality beat.
I'd agree. The top line numbers, for instance, really jumped out.
Yeah, revenue hit, $3.05 billion?
Right, and the consensus was more like $2.84 billion. So, yeah, comfortably sailed past that.
And bottom line, too, earnings per share, $92 diluted.
Which beat estimates by about 7-11 cents. So yeah, a clear win on both revenue and earnings.
But the driver behind a lot of that, it seems, was membership growth.
Oh, absolutely. That's, I think, a huge piece of the story here. Membership swelled by 41% year over year.
41%. That's massive. How many members is that now?
Just over 2 million. 2.04 million to be precise.
Oh. And that scale, that's critical for their efficiency, right?
Exactly. It directly ties into their operational efficiency gains, their SG&A ratio, selling, general, and admin costs.
Yeah, basically their overhead percentage.
Right. It improved by 260 basis points, dropped to a record low for them, 15.8%.
That 15.8% is, that's really something.
It's a powerful signal, yeah.
Now, the MLR, the medical loss ratio, how much they pay out in claims versus premiums, that did tick up a bit.
It did, slightly,
Okay.
to 75.4%. But importantly, the operating profits still grew pretty significantly.
So those scale efficiencies, that lower SG&A, it kind of pushed through that slight MLR increase.
That's the story. It led to a material beat overall.
Let's dive a bit deeper into those financials then. That $3 billion in total revenue, that's a 42% jump year over year.
42%. And like you said, it fueled the bottom line. Net income was around $275 million.
Which is what, almost $100 million more than last year?
$98 million increase over a prior year, yeah. It really shows that top line growth is hitting the bottom line now.
And the earnings from operations numbers back that up. Grew by $112 million.
To $297 million total. And the operating margin itself improved 110 basis points year over year, up to 9.8%.
Okay, but back to that SG&A. 15.8%. Record low. How did they get there?
Well, they broke it down. About 40% of that improvement came from fixed cost leverage.
Meaning their tech platform, their infrastructure, it's handling more members without costs rising as fast.
Exactly. Then about 15% came from improvements in their sort of variable cost structure. And the rest was from lower exchange fee rates. But the key thing they stressed
was that it's durable, not just a one-off quarter.
Right. They see it as a more fundamental shift towards efficiency.
Interesting. Now, that MLR increased to 75.4%. You said it was slight, but what caused it?
Yeah, there's some nuance there. It was mostly driven by a $31 million unfavorable prior period development.
Okay, prior period. So not necessarily current claims spiking.
Correct. It stemmed from an increase they had to book for their 2024 risk adjustment payable.
Risk adjustment. That whole system balancing healthier versus sicker members across insurers.
Exactly. So this was like a true up or re-estimation for a prior period. It wasn't about Q1 claims patterns themselves.
And did anything offset that?
Yeah, partially. They had some favorable claims run out, old claims settling for less, and also a CSR recovery. That's cost sharing reduction payments.
Got it. But that risk adjustment piece alone added about 60 basis points year over year.
That's what they said, yeah. Around 60 BP's impact.
So it really does sound more like an accounting item than a sign of, worsening health trends in their current pool.
Seems that way. And on utilization trends for Q1.
What do they say there?
They saw higher inpatient use, but that was actually offset partly by good trends in pharmacy costs.
Okay. And outpatient. Professional.
Largely in line with what they expected.
And all that, combined with the efficiency gains, led to adjusted EBITDA of
$329 million, which again shows strong operational profitability improvement, $110 million better than last year.
That's a hefty improvement. Okay, let's shift gears to membership and strategy. You said 2.04 million members.
Right, about 2 million effectuated members, meaning active paying members.
And that 41% year-over-year jump, or 22% just since Q4, what drove that?
They pointed to strong retention, which is key. Plus, growing faster than the market during open enrollment and also adding members during special enrollment periods, or SEPs.
It seems pretty consistent growth.
It does, and they connect that growth back to, well, a couple of things. Innovative plan designs.
Like those condition-focused plans they have.
Exactly, and also what they call a superior member experience driven by digital engagement.
Right, using tech to manage care, intervene earlier.
Which ties back to controlling costs, ultimately. And they launched something new, too, didn't they?
Yeah, OSCR Community Resources, partnering with Find Help.
Right, connecting members to social care services, food, housing, transport.
That's addressing those social determinants of health, trying to lower spend long-term by tackling non-medical needs that impact health.
It's a fascinating approach, very holistic.
And on the pure tech side, OSCR's bread and butter.
They highlighted a new free live chat feature for their virtual urgent care.
Free chat. How did that perform?
Pretty impressively, actually. They said it cut member response times by 90%, and boosted provider efficiency by 28%.
Wow. Okay. That's not just bells and whistles. That's real impact.
And they also mentioned a new AI tool for their care guides, helping them handle member queries faster.
So continuous tech investment feeding into that efficiency and that SG&A number.
It seems to be a core part of the strategy. Absolutely.
Okay, so what about the outlook? Full year guidance. Did they raise it after such a strong Q1?
No, actually. They reaffirmed all their full year 2025 metrics.
Reaffirmed. Which in itself is a signal of confidence, I suppose.
It is. They're still expecting total revenue between $11.2 billion and $11.3 billion.
But the membership outlook got a bit more nuanced, right?
Yes, and I think this shows some good transparency for management. Wow. Even though Q1 membership beat their expectations.
They're now factoring in a potential policy change.
Exactly. The proposed end of the monthly SF, that special enrollment period, for people under 150% of the federal poverty level.
Okay. So how does that affect the year?
They expect membership to trend up in the first half because of that strong Q1 start, but then trend down in the second half if that SF rule changes.
Interesting. So the year-end number might be lower than you'd guess from Q1.
Right. They're guiding towards about 1.8 million members by year-end.
But they kept the revenue guidance the same.
They did. Which implies, higher average revenue per member is offsetting that potential dip in the total number of members later in the year.
Makes sense. And the other guidance points, MLR, SG&A for the full year.
Also reaffirmed, MLR expected between 80.7% and 81.7%. And the SG&A ratio target is 17.6% to 18.1% for the full year.
So higher than the Q1 record low, but still showing significant full-year improvement.
Exactly. And they confirmed the earnings from operations guidance, too, $225 to $275 million.
And they sound pretty confident about hitting net income profitability for the year.
Very confident, yeah. And achieving, quote, meaningful margin expansion. That's a big focus for them now.
It really feels like a shift from growth at all costs to profitable growth.
I think that's fair. The market certainly seemed to react that way.
Yeah, let's talk market reaction.
Yeah.
The stock popped pretty hard after the release, didn't it?
Oh, yeah. Closed up 30.2% the next day, $17.02.
30% on huge volume, too, like 5 times average.
That's right. It was a big move. That beat and the steady outlook, it really seemed to flip sentiment. Very bullish reaction.
Especially considering the setup before earnings.
Right. The stock had slumped after Q4 results back in February.
Down like 15%.
Yeah. And then it traded sideways after UnitedHealth had that forecast cut in April, which kind of spooked the whole sector a bit.
And the chatter before OSCR's earnings was pretty muted. Plus, short interest was high.
Exactly. Elevated short interest. So when that positive surprise hit, it likely triggered a pretty significant short squeeze, amplifying the move up.
Made the pop even bigger.
Seems likely.
Right.
Other health insurers rallied a bit too in sympathy, but their gains were much smaller.
Suggesting investors are still maybe a bit cautious about broader cost pressures in the sector, but OSCR stood out.
That's how it looks, yeah. OSCR broke away from the pack on this news.
Okay, what about the regulatory side? Policy stuff always looms large in healthcare.
For sure. OSCR actually views some of the proposed CMS integrity initiatives, targeting fraud, waste, abuse as a positive.
Why positive?
They think it helps market sustainability long term, levels the playing field.
Okay. But they do have some concerns.
Yes, particularly about a proposed shortened enrollment window for 2026.
They think that would make it harder for people to shop for plans.
That's their concern, especially if those enhanced premium tax credits, the subsidies, expire around the same time. That could be a double whammy.
So they're actively lobbying on this, engaging policymakers.
They are, both federal and state, on both sides of the aisle, trying to advocate for, constructive solutions for the individual market.
Which they frame as being pretty vital, right? Driving low uninsured rates, keeping cost trends down.
Yeah, they see it as a cornerstone.
Yeah.
And it's important to remember, a lot of Oscars members do receive subsidies, so these policies directly impact their business model.
Makes sense. And competitively, how are they looking at things like Centene pulling out of some markets?
They see it as a straight-up opportunity.
Really? Not worry about taking on potentially sicker members?
Apparently not. They mentioned significant overlap where competitors are exiting, so they expect to capture members.
And they think risk adjustment handles the risk profile.
That's their view. They believe risk adjustment levels the playing field effectively, so the new members should be consistent with the overall marketplace risk.
So they see competitor exits as pricing problems for the other guys, not a fundamental issue with the market itself.
Pretty much. It speaks to their confidence in their own pricing and efficiency, I think.
Interesting take. What about ICRA, that individual coverage HRA market?
They noted more momentum there, seeing more interest from larger middle market employer groups.
That's where employers give money for employees to buy individual plans instead of a group plan.
Correct. Oscar's advocating for a fix to a tax credit issue there, believing it will help build even more momentum if employers get parity.
Okay, and just quickly, seasonality, what should we expect going forward this year?
For MLR, they expect a slightly flatter trend than usual through Q2, Q3, Q4. But still a step up in Q2, and Q4 likely being the highest, which is typical.
As utilization picks up.
Right, and for SG&A, they expect gradual increases each quarter from that very strong Q1 base we saw.
So, still improving year over year, but sequential increases from Q1.
That's the expectation. And importantly, they said they're already planning for 2026 dynamics.
Thinking about potential impacts from those integrity rules or subsidy changes?
Yeah, they're building that into their pricing strategy already, aiming to maintain competitiveness and keep improving margins even with those potential headwinds.
Shows they're not just resting on their laurels after one good quarter.
Definitely planning ahead.
All right, let's move to our segment we call Not Financial Advice. And we have to stress, this is absolutely not financial advice.
Please, always do your own research, your own due diligence.
Seriously. But looking at everything we've discussed, the strong beat, the solid outlook, that whole short interest situation.
You think there might be more upside?
Well, our outrageous but plausible trade idea for you to consider is this. Maybe initiating a long position in Oscar Health, ticker OSCR.
Okay. How? Buying stock.
Specifically, maybe purchasing out-of-the-money call options that expire later, say Q4 2025.
Using options for leverage. Why that strategy?
The thinking is it could capitalize on any continued short covering, first off, and also a potential re-rating of the stock as the market really digests this clearer path to sustainable margin expansion.
So you're betting the market still hasn't fully priced in their operational leverage, even after the 30% pop?
Potentially. Given that record low SG&A and the reaffirmed guidance, maybe the current valuation doesn't fully reflect their positioning, especially as the market consolidates. Again, just an idea, not advice.
Definitely not advice. Okay, so wrapping things up, Oscar Health, a very strong start to 2025.
Yeah, impressive growth members, revenue, and really significant, seemingly durable gains in efficiency.
Their strategy, based on tech and those innovative plans, seems well set to hit their full-year goals.
Even with policy shifts and competition always swirling around them.
And the market's reaction was certainly enthusiastic, a big signal of confidence in their path to profit and better margins.
So final thought for you listening, as you look at Oscar Health, what stands out most? Is it their tech-first approach? Their ability to navigate tricky policy waters?
Yeah.
Or maybe how they're handling growth and efficiency at the same time in this tough healthcare market? Something to think about.